Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to talk about Bitcoin and we're going to look at the risk metric, which we haven't spoken about in a couple months on the channel. So if you guys like the content, please subscribe to the channel to be here every step of the way. Give the video a thumbs up and also check out the Telegram channel, which you can find a link to in the description below. Let's go ahead and jump in. So this is our trusty risk metric for Bitcoin. This chart is the price of Bitcoin on a logarithmic scale. So if you're not familiar with logarithmic scales, make sure you identify the fact that each major tick goes up by 10x. This is very useful for identifying changes in the price of an asset that spans order of magnitude. Because if you don't use a logarithmic scale, it basically hides all the stuff that happened at the lower prices. It's price versus time, and it's color coded based on the risk metric. And the risk metric is useful for identifying key momentum shifts in the market, right? So you can see that if we just put on the peaks here, there's been 4 definitive times in Bitcoin's history where we've had peaks, local peaks that went to the upper risk bands. So above zero point 0.8, 3 of these went to above 0.9. The reason why this is useful is because it can help us identify the fact that Bitcoin is seeing diminishing returns. Okay, because the thing is if you use something that did not account for diminishing returns, then these peaks over here would look different than this one, because honestly these peaks were a lot more substantial than this one. This was a 100x move, but these moves were even a lot higher than that. So because of that, we've tweaked the risk metric to account for diminishing returns. In the same way that it can help us identify theoretical tops, it can help us identify theoretical bottoms. We've had plenty of these throughout the years, one here, in this bear market, we had it in this bear market, and then Bitcoin was nice enough to give us one more time this market cycle back in March at a risk level that was, this one actually went to around 0.12. So normally we don't get that low very often. You can see it happens very infrequently throughout the market cycle, but it got there in March of 2020. So this risk metric goes from 0 to 1. When it's close to 0, it means it's a theoretical good time to buy. When it's close to 1, it's a theoretical good time to sell. As we get into the yellow region, it's more or less no man's land, right? We don't really know where it's going to go. We've had several examples where it continues to rally on up higher to these local peaks, global peaks of those market cycles, more or less. But we've also had times where we get up into the yellowish region, and then we come back a bit before rallying on. For instance, in 2019, we had a move that took us to approximately this risk level, right? Approximately where we are now, and we did not rally to the top. Okay, so just because we get to this point does not mean we are about to, rally on up to the top of the wristband. But the nice thing is we are prepared for it, whether it does or not. So this is the important part. It doesn't matter what we think. It doesn't matter what we feel. The money to be made does not care about our emotions. All that we need to know is that the risk level is going up, and right now is a lot riskier time to buy Bitcoin than it was back in March. Remember, you buy into the fear and you sell into the greed, not the other way around. If you're chasing a pump, this is not the right way to go about doing it. This is not financial advice, but as we've said before, it is better to you never chase a pump, but you must always be ready for that pump. You accumulate the asset when it's quiet in the market, or there's fear everywhere in the market. That's when you accumulate. And when it goes up and everyone's grandmother is starting to buy Bitcoin, this is where you have to think, okay, is this the smart money coming into the market, or is this the dumb money coming into the market? And so this is the main point. So if it can be kind of hard to figure out, okay, well, what is this numerically, right? What is the risk level numerically speaking? So what we're going to do is we're going to take the color out of it. The blue line shows the price of Bitcoin on this primary y-axis, and the orange line shows the risk of Bitcoin on the secondary y-axis. So the orange line corresponds to this axis over here. Now, I should say I made this presentation last night when Bitcoin was at 18.3K. As I'm making the video now, Bitcoin has rallied to 19.3K, so it's $1,000 higher. So in fact, this risk metric is slightly out of date. It's hard to make the videos sometimes quick enough because I'll put the presentation together. By the time I get around to making the video and publishing it, the market has completely changed. But you can see that we've rallied up above a risk level of 0.6. Now, if you guys follow the channel, the public channel, you're aware that since I've been talking about the risk metric on the channel, we have been below 0.5 risk because I published it around this point over here in late 2019. And since then, we've been below 0.5 risk. However, we have recently completely traversed the 0.5 to 0.6 risk band, just like we did in 2019. And we are approaching that prior local top in the risk of Bitcoin. You might wonder, well, how does this make sense? Because in 2019, the price only rallied to 14K, but now we're knocking on the door of 20K. Remember, the risk levels are dynamic. They allow us to, they constantly change depending on Bitcoin's price and volatility and the time it's taking. And so because they adjust, it allows us to use it consistently throughout each market cycle. We don't have to change anything, right? It just automatically adjusts to wherever we are within that phase of Bitcoin's life, right? And so if you look at the local bottoms, or you could call these the global bottoms of each market cycle, you can see that we tend to visit regions below 0.2 risk, right? We come down here every so often, and when we do, it is quite substantial because at the time there's fear everywhere. Everyone is very worried about what Bitcoin's doing. You'll get a lot of the Bitcoin is going to zero articles coming out, that sort of stuff. But however, we know, because we're not the dumb money, we're not the ones selling down here, right? We come into the market and pick it up, right? We come in and say, this is the fear. This is irrational fear, not irrational FOMO like up here. It's irrational fear, and that's when you want to buy Bitcoin. Not up here at the peaks when everyone's buying it, but down here. That way, when the time comes and you find yourself, when the time comes and Bitcoin is rallying on up from where you bought it, you're already up several more multiples than someone who waited for a different type of signal. Imagine people were waiting until Bitcoin broke the prior all-time high before they buy in. So imagine they say, okay, I'm not going to buy Bitcoin until it gets to 20K. Well, the people that were buying it down at 3 and 4K, they're already up 5, 6, 7x or so before Bitcoin even gets to 20K. So these guys are the ones that will apply the incredible sell pressure up here, because as the price rallies, and if Bitcoin's above 20K, the sell pressure from these guys is already going to somewhat come into play because they're already at 5x. Whereas the people that are buying it at 20K are a lot more, it'll be a much more knee-jerk reaction for them if they wake up and see Bitcoin has dropped from 20K and it's dropped back down to like 16K or something. In that scenario, these guys that bought at 20K might be overexposed. The guys that bought at 3K, 4K, 5K, 6K, and so on, it's who cares, right? It's rallied so much. A 20% pullback, a 30% pullback, sometimes even a 40% pullback is business as usual in a bull market. So in the same manner, the people that one day might be buying Bitcoin at 100K and they're gambling on it to go to 200K, if you were buying it below 10K for the most part, which is where we spent most of our time buying Bitcoin, then you're already up more than 10x, right? You're already up more than 10x, maybe 20x or 30x by that point. So the sell pressure coming from these guys will likely start overweighing the buy pressure coming from dumb money in the market. So one way that you can go about thinking about doing this, these are local tops, is to split it up. Let's be pragmatic about it, split it up, say, what if I just create a selling strategy based on the risk metric where I sell various amounts as we go up the risk levels, but I keep most of my Bitcoin for the higher risk band. And in the same way, we can do it dynamically going down. So if the price of Bitcoin is not really moving a whole lot, it's been going sideways for a while, maybe the risk level is in this region, you're just putting in a little bit of money each week or a little bit of money each month. But in the very rare cases where it dips down to these levels, then you're able to push more money into the market. And that's why having some dry powder on the sideline is typically a good thing, because it allows you to get back in. It allows you to push it in whenever there is a dip in the market, and those dips do not come very frequently. And I can't promise you, I mean, there's a really good chance now that we do not revisit this risk regime, this market cycle. It could be years before we come back down into this risk level. I don't know. I mean, we could revisit it next year, but it might not happen. And the point is it doesn't matter what we think, it doesn't matter what we feel. Our emotions are completely irrelevant. What I do, generally speaking, is I'm buying Bitcoin when the risk is below 0.5, and I look to sell it when it's above 0.5. And it's a systematic strategy so that I sell more, increasing amounts as it goes up. So imagine you had 15 Bitcoin the minute you cross 0.5 risk. If we add these areas up, so y plus 2y plus 3y plus 4y plus 5y gives you 15 total. 15y, let's say you had 15 Bitcoin, so 15y equals 15 Bitcoin. Y would equal 1 Bitcoin. So then at this level, you might sell 1 Bitcoin. At this one, 2, 3, 4, and 5. So 1/15, 2/15, 3/15, 4/15, and 5/15. Therefore, if it does rally on up to the top, then at least you're selling 4/15 and 5/15, which is 9/15 or 3/5 of your Bitcoin at the local peak, or I mean at the global peak for the market cycle, right? So you'd be selling 4/15 and 5/15, which adds to 9/15, which is 3/5 of your Bitcoin at the higher point. The nice part about it is it allows you to sell some at the lower risk levels for cases where you come up and then come back down. And so if it does do something like this, where it retraces back into these risk bands, then you can reinvest the money that you pulled out, even though it would have only been a small amount, because it would have only been 1/15 of your Bitcoin if it were in this risk band, 2/15 here, 3/15, and so on. So it allows you to take a small amount of profits at the lower risk band in case you see a retracement back down, while also leaving most of it on the table. And you can even see that even in a bull market, right, of 2017, we even went up to 0.7 risk and then came back down to this level at one point. So you have to consider that is a possibility. We might not just go up monotonically to 0.9 to 1 risk. If it does, we'll be ready for it. There's no guarantee that there's no guarantee of anything, right? There's no guarantee exactly where it will go, but you can see we are honing in on the risk that we reached in 2019 at 14K, despite that now we are knocking on the door of 20K. It's because the risk levels adjust over time, and so we're going to be ready for whatever happens. Now, some of you guys might prefer a slightly different approach, right? Sometimes tax implications can cause you to not want to buy here and sell here. So what you could do is you could create like a gray region in between this level and here. So maybe you buy Bitcoin when the risk is between 0 and 0.4 and you sell it between 0.6 and 1. This is one possibility. You could be a little bit more aggressive. And then that way, if you did this, you would have maybe these risk bands, so X, 2X, 3X, and 4X, and then you would split this up into tenths. So instead of, it would be 1/10 of your Bitcoin, 2/10, 3/10, and 4/10. You could be more aggressive or more conservative, the way you want to look at it, and maybe you only buy Bitcoin when it's below 0.3 risk. Maybe you're more interested in equities, but you recognize the risk-adjusted returns for cryptocurrency can sometimes be rather attractive. So you just wait and see, okay, when is the risk level down here? That's when I'll enter the market, and then I just simply wait for it to come up into this region. You could be even more aggressive and do something like this, where you wait for those very infrequent times during the market cycle where the risk gets all the way down below 0.2, and then maybe you don't sell until the risk gets above 0.8. So you're more of a hodler in a sense, where you buy, but you really just simply don't sell until at least where we think the local peak will be in. And that way you're avoiding even more tax implications. The problem with this strategy, or I wouldn't say problem, but let's say a feature. One feature of this strategy is that what if you don't make it back down to this risk level, this market cycle? What if we come back down to 0.45 risk at some point, and we don't make it down here? Then it might never give you the opportunity to buy back in. Or what if we peak at 0.79 risk and don't make it to this point? So it's an idea of what do you stand to leave on the table if we don't make it up to that risk level that we were potentially anticipating. And the point is to recognize we don't know where the bottoms are. We don't know where the tops are, but we can at least try the best we can to enter and exit the market based on where the risk levels are and what that means historically. Now, the risk level is it's based on price, time, and volatility. It's something I made. If you guys want access to it, remember you can sign up for the premium list at intothe.cryptoverse.com. However, if you want the Black Friday sale, remember to check out the link in the description below, because this link has a discounted price on the premium list and you can lock it in perpetually as long as you don't cancel. So you'll get access to weekly premium reports that have a lot of these charts in them, weekly premium videos that tend to be a lot longer than my public videos, if you can imagine, and more detailed as well. You also get access to the Telegram alerts channel, the private Telegram chat room, the risk dashboard, which has the numerical value, the numerical risk levels for Bitcoin, Ethereum, Link, ADA, and a few other coins, Litecoin, XRP, and a few others. So make sure you check that out. And you also get access to some of the trading view indicators. So if you're looking for a community to navigate with this market cycle and you want to get on the premium list, make sure you check out the Black Friday sale. It'll be going on for about 9 more days. Check it out. Hopefully this content has been useful to you guys. I hope you guys enjoyed the update on the risk metric. Remember to subscribe to the channel if you guys like the content, so you'll be here every step of the way. Give the video a thumbs up. Check out the Telegram channel in the description below, and I'll see you next time. Bye.